1. The cold opening, the unseen countdown. We begin not with charts, but with a question of belief. What happens when the collective faith of an entire generation, built on two pillars, the permanence of prosperity and the competence of the government, is shattered? What is the cost of that betrayal? Think back to the financial crisis of 2008. The mechanisms that caused it were complex, yes, but the root cause was simple: belief. Belief that home prices only went up. Belief that the Federal Reserve would always save the day. That lie cost $13 trillion in household wealth and 8.8 million jobs. Today, we are facing not a lie, but a mathematical certainty. A hidden timer is counting down to economic catastrophe, and it is buried deep inside the US Treasury Market. According to the most reliable patterns in global finance, that timer hits zero sometime in March 2026. This is not conjecture. This is not fear-mongering designed to sell you a product. This is the yield curve inversion, a signal that has delivered perfect accuracy for the past 50 years. Zero false signals. Zero missed predictions. Right now, that signal has been running for an unprecedented 21 months. Banking reserves are collapsing. Corporate insiders are liquidating assets faster than at any time since the chaotic weeks of late 2007. And the Federal Reserve, the institution tasked with protecting the American financial system, just made the ultimate confession of failure by pausing quantitative tightening. QT. They admitted they are powerless to control the very markets they oversee. We are not merely looking at a cyclical downturn. We are witnessing the guaranteed breakdown of the US Treasury Market, the foundation of all global finance. Every mortgage rate, every corporate loan, every bank's balance sheet, every pension fund's solvency, it all rests on the stability of this single market. When the Treasury market malfunctions, everything else breaks. In this exhaustive, multi-part documentary-style analysis, we will spend the next hour and a half meticulously dissecting the mechanisms that guarantee the 2026 crisis. We will walk you through the four escalating stages of this collapse, expose the hidden dangers in the shadow banking system, reveal the technical data points that prove we are beyond the point of no return, and provide the comprehensive, actionable plan you need to survive. 2. The first principle, the yield curve's unforgiving calculus. We must begin with the source of this certainty, the yield curve inversion. For decades, economists treated the yield curve inversion as merely a predictor. They said it was a statistical quirk. But they were wrong. The inversion doesn't just predict recessions, it causes them. The core mechanism, the death of the net interest margin. Banks operate on a simple principle: borrow short-term, paying depositors low rates, and lend long-term, earning higher rates on mortgages and loans. The difference is their profit, the net interest margin, NIM. When the yield curve inverts, short-term rates exceed long-term rates. This brutally simple act of financial physics causes the NIM to vanish, often turning negative. Why is this so catastrophic? Because banks are rational actors. They cannot lend money at a loss. When traditional lending becomes unprofitable, banks stop lending. This is the credit transmission mechanism grinding to a halt. Credit dries up. Businesses cannot access the capital to run their daily operations. Consumers are locked out of buying homes and cars. Economic activity suffocates. Companies are forced to lay off workers. Unemployment rises. The economy contracts. Recession begins. This sequence is not theory, it is a proven law of financial thermodynamics. Deep dive, the credit contraction proof, SLOOS analysis. We do not have to wait for the unemployment numbers. The Federal Reserve's own Senior Loan Officer Opinion Survey, SLOS, provides a real-time X-ray of the banking system's health. For 6 consecutive quarters, the SLOS report has shown a systematic, consistent tightening of lending standards across all categories: commercial, industrial, and consumer. This is the credit freeze in slow motion. The banks know the yield curve is inverted. They are already protecting their balance sheets by starving the economy of capital. This protracted tightening is the foundation upon which the 2026 recession is being built. The financial psychology trap, normalizing danger. The reason this inversion has run for 21 months, exceeding all previous post-World War II records, is because of the artificial liquidity buffer created by previous quantitative easing, QE, cycles. The market is not predicting recovery, it is predicting that the Fed will be forced to panic and cut rates to zero. The longer this signal runs, the larger the economic debt being accumulated. The most dangerous human tendency is the normalization of danger. By the time the inversion is 21 months old, everyone is tired of waiting. Optimism creeps back in. This false sense of security is precisely what allows the final phase, the chaotic unwinding of bad debt, to happen with maximum and lethal violence. 3. The uncontrollable monster, the Fed's liquidity dependence trap. This crisis is worse than any post-war recession because of the structural dependency the Federal Reserve engineered, the $9 trillion balance sheet. It's not just a large number, it's an institutional addiction. Deep dive, the structural flaw of QE. When the Fed conducted QE, it flooded commercial banks with reserves. Crucially, academic research shows that banks finance these reserves with highly unstable, uninsured demand deposits while simultaneously issuing massive corporate credit lines. When the Fed started quantitative tightening, QT, the liabilities remained, but the buffer disappeared. This creates a massive and systemic liquidity mismatch. The Fed's halt of QT is the loudest, most undeniable confession: we are unable to normalize our own balance sheet. They are pausing QT because liquidity is drying up so fast that the US Treasury market itself, the absolute core of the global financial system, is seizing up. The technical proof of institutional fear, the fear is palpable in the overnight lending markets. Banking reserves have plummeted. The overnight interbank rate is spiking above the Fed's official target rate. This highly technical indicator is a classic sign of liquidity stress. Banks are refusing to lend to each other, even overnight, because they view their peers as potential credit risks. This loss of trust among institutions is the prerequisite for a financial crisis. The Fed is intervening not to save the economy, but to prevent the primary market for US government debt from failing. The shadow banking time bomb, the problem extends far beyond traditional banks. A massive amount of lending now happens in the shadow banking system, unregulated entities like private credit, hedge funds, and money market funds. This sector, holding trillions in assets, relies entirely on stable liquidity from the Treasury market. When the Treasury market seizes up, when liquidity dies, the shadow banking sector, which the Fed has no direct mechanism to bail out, will suffer an immediate, catastrophic, and unregulated collapse, far exceeding the damage seen in 2008. We are staring down a coordinated failure of both regulated and unregulated finance. 4. The four horsemen of the collapse, the mechanism of destruction. The four stages leading to the 2026 crisis, each a horseman of the collapse, gathering speed and ferocity. Horseman I. Invisible cracking, the quiet buildup. Banks subtly tighten lending. CFOs build cash reserves. Horseman 2, visible dysfunction, the public warning. Treasury auction results stress. The Fed pauses QT. We are here, but the window to act is closing. Horseman 3, systemic shock, the breaking point. Mark-to-market losses. The latent insolvency in the banking system is realized. Deep dive, the math of unrealized losses. The core mechanism here is the value destruction of bonds. Every 1% increase in Treasury yields reduces the value of existing 10-year bonds by roughly 8% to 10%. Banks are sitting on hundreds of billions in unrealized losses on these bonds bought during the era of near-zero rates. The moment a large number of depositors panic, even a minor event, banks will be forced to sell these bonds at catastrophic losses, turning an unrealized loss into a realized solvency crisis. The corporate debt time bomb, this is amplified by a corporate debt bomb. Over the last decade of easy money, companies piled on cheap debt. Now, over $4 trillion in corporate bonds needs refinancing in the next 3 years. With high interest rates, refinancing is impossible for the weaker, zombie, companies. This guarantees a massive wave of corporate bankruptcies, leading to mass layoffs, and a second, brutal wave of loan defaults hitting the regional banks. Horseman 4, catastrophe and contraction, the inevitable result. The hidden timer hits zero. The system breaks. The Fed is trapped between inflation, deflation, and financial crisis. V. The CRE time bomb and regional bank annihilation. The Treasury market dysfunction is directly transmitted into the real economy via the commercial real estate (CRE) sector. This is the regional bank killer. Deep dive, the unbreakable math of default. The $2 trillion debt wall that matures in 2025 and 2026 is mathematically unserviceable. Why? Because the interest rate required for refinancing has tripled. A property that generated just enough cash flow to cover debt service at 3% is instantly insolvent at 9%. Building owners are choosing strategic default, walking away because the property is worth less than the loan. The annihilation of regional banks detailed. Regional banks are not merely exposed, they are criminally overexposed. They hold nearly 50% of all CRE debt in the US, and for many, CRE constitutes over 40% of their total loan portfolio. When the defaults hit in waves, the losses will instantly wipe out the capital reserves of regional institutions. This is not a drill. This is a solvency crisis leading to a full-blown banking crisis that will paralyze local credit and plunge the nation into recession. 6. The dollar's endgame and geopolitical fallout. The ultimate consequence of this domestic failure is the collapse of global faith in the US dollar, USD. Deep dive. The collapse of reserve currency trust. The world trusts the dollar because it trusts the US Treasury Market, the safest asset globally. When the Fed is forced to restart QE in 2026, printing money to buy its own debt, it sends an undeniable signal to global powers that the US is using its money printer to solve its solvency problem. The great power shift and de-dollarization. This political confession will immediately accelerate the de-dollarization trend. Foreign central banks will liquidate Treasury holdings, forcing US yields even higher and creating a vicious feedback loop. This is the ultimate cost of Fed failure. The dollar's loss of reserve status means higher prices for US imports, permanently higher interest rates for the US government, and a permanent reduction in the American standard of living. The crisis starts on Wall Street, but it ends with a global power shift away from the US. 7. The psychology of the crash and the survival strategy. The professional is preparing now. The question is whether you will adopt their mindset. Psychological warfare. Defeating the herd. The core strategy of the ultra-wealthy is to capitalize on the panic of the masses. They are liquidating assets now. Warren Buffett is sitting on over $300 billion in cash. They are not preparing to simply survive, they are preparing to acquire assets at a massive discount when fear drives valuations to zero. Your goal must be to join them. Here is your comprehensive action plan, based on the 4 stages of this coming crisis. Eliminate leverage, get rid of all high-interest consumer debt. Do this immediately. Maximize liquidity, and increase your cash reserves. Ensure you have 12 to 18 months of expenses saved. Cash will be king. Hedge against uncertainty, and shift capital toward assets that protect wealth. Short-term treasury bills, the only non-credit risk asset, physical gold and silver, and stable dividend-paying defensive stocks, healthcare, utilities. Secure your income, recession-proof your skills. Develop multiple, non-market dependent income streams. Your ability to generate cash flow outside the financial system will be your most valuable asset. The hidden timer is running out of time. The yield curve inversion has created unstoppable momentum toward a 2026 recession. The Federal Reserve has admitted they've lost control. Call to action. If this detailed analysis gave you the clarity to protect your financial future, hit the subscribe button. We analyze the raw data and financial mechanisms that predict the future. Don't be caught unprepared when the final stage begins.